You ran the numbers. One fund sale, a small gain, $4,300. 2 years later, Medicare sends a bill that is $2,297 higher. Every year, for both of you, you did not make a mistake. You crossed a line nobody told you existed. If you were manning your 40s or 50s, managing your own retirement accounts, doing the conversions, timing the withdrawals, trying to optimize, this is not a planning failure. It is an architecture problem. And the architecture has a name. The system is called IRMAA, the Income-Related Monthly Adjustment Amount. It is a Medicare surcharge that operates as a cliff, not a slope. And the cliff is invisible until you have already gone over it. Today we are going to name the mechanism, walk through exactly how the math works, and give you the protocol to stand at the edge without falling. Let's start with betrayal. Most people picture Medicare premiums as a fixed cost. You turn 65, you sign up, and you pay the standard rate. In 2026, that standard rate for Part B is $202.90 a month. Predictable. Simple. That is the story you were told. Here is the one you were not. Medicare does not charge everyone the same rate. It looks at your tax return from 2 years ago and decides which tier you belong to. If your modified adjusted gross income, your MAGI, stays below $109,000 as a single filer or $218,000 filing jointly, you pay the standard rate. The moment you cross that line by $1, you owe the full Tier 1 surcharge. Not a portion of it, not a proportional slice. The entire thing. $81.20 extra on Part B each month, plus $14.50 extra on Part D per person, per month. For a married couple where both spouses are on Medicare, that is $95.70 per person per month, times 2 times 12. That is $22.97 a year, triggered by $1 of income above the line. This is what I call the IRMAA Cliff. It is not a penalty for being wealthy. It is a threshold that behaves like a trapdoor. Step on it and you fall the full distance. There is no phase-in. There is no proration. The system does not care that you missed the edge by $1 instead of $1,000. Now here is where it gets worse. I want you to visualize 2 lines on a graph. The horizontal axis is time. The vertical axis is your Medicare premium. For years, the line runs flat. Standard rate, month after month. Then 1 year, your income spikes. A Roth conversion, a fund sale, a bonus from selling a rental. The line on the graph does not move immediately. It stays flat. 1 year passes. Still flat. 2 years later, the line jumps. Hard. Straight up to a new level. And it stays there for the entire year. That gap between the income event and the premium jump is what I call the 2-year shadow. Your 2024 income sets your 2026 Medicare bill. Your 2025 income sets your 2027 bill. Your 2026 income is already setting your 2028 bill right now. The decisions you make today cast a shadow 2 years forward, and by the time the higher bill arrives, the income event that caused it is long closed. You cannot unwind it. You cannot appeal it. You are just paying it. This is the planning gap that costs retirees thousands of dollars every year. Not because they were reckless, because they optimized for one thing, tax brackets, or long-term Roth growth, or capital gains timing, without knowing there was a second system watching the same number and responding 2 years later. Let's look at the math on a real scenario. Marcus is 63 years old. He just retired. He has $1.4 million sitting in a traditional IRA. His financial advisor recommends a Roth conversion. Smart move in isolation. Convert now at a lower tax rate. Avoid bigger required minimum distributions later. Leave tax-free money to his kids. Marcus converts $150,000 in 2026. His other retirement income, Social Security and a small pension, puts his base MAGI around $195,000. The conversion pushes total MAGI to $345. Marcus feels good. He did the tax math. The conversion made sense. 2 years later, Marcus turns 65 and enrolls in Medicare. The Social Security Administration looks at his 2026 tax return. His MAGI of $345 lands him in Tier 3. His Part B premium is now $527.50 a month instead of $202.90. His wife is on Medicare too. For the couple, that is an extra $649.20 in Part B alone every month. Add Part D surcharges for both of them. Total additional Medicare cost for 2028 nearly $10,000. For 1 year, because of one conversion decision in 2026. And here's the part Marcus cannot fix. The IRS eliminated Roth recharacterizations in 2018. Once the conversion is done, it is done. The money is in the Roth. The IRMAA bill is coming. There's no reverse gear. This is the Paycheck Lab. We decode the systems that run in the background of retirement while you are focused on the numbers everyone tells you to watch. If that sounds like something worth your time, subscribe. It costs you nothing and it might save you a significant amount of money. Now let me show you the edge case that reveals just how sharp this cliff really is. Income Lab ran the math on a couple doing a large Roth conversion. They had room in the 24% federal bracket, so they converted right up to the edge. Then they added $10,000 more to the conversion. Just $10,000. That pushed their MAGI across the next IRMAA tier. That last $10,000 generated about $2,400 in federal tax savings at the 24% rate. But crossing the IRMAA tier cost them $3,473 in additional Medicare premiums 2 years later. Net result, a loss of over $1,000. The effective marginal tax rate on those last $10,000 was 58.7%. Not because of the income tax brackets, because of the cliff they did not see. You might be thinking, I am nowhere near that level. My income is not in the 200s. Let me show you how many ways a normal retirement year can push you there without you expecting it. MAGI for IRMAA is not just your salary or your pension. It is your adjusted gross income plus tax-exempt interest. That includes Roth conversions. The entire converted amount counts as ordinary income in the year you convert. It includes required minimum distributions, which start at 73. It includes capital gains from selling a fund, a rental property, or a business. It includes taxable Social Security. Up to 85% of your benefit may be taxable. And it includes something that catches a lot of people, municipal bond interest. Muni bonds are federal income tax free. They are not IRMAA free. That income counts. The line that says tax-exempt interest on your 1040, line 2A, goes directly into the IRMAA calculation. So here is what our normal year can look like for a couple filing jointly. Social Security, $90,000 taxable. Pension, $40,000. IRA distribution, $50,000. One fund sale, $35,000 in capital gains. Total MAGI, $215,000. That is $3,000 under the cliff. Now their advisor recommends a small Roth conversion to reduce future RMDs. $50,000. Total MAGI, $265,000. They're in Tier 1. The bar just jumped. Bill goes up $22.97 starting 2 years from now. None of those income sources are reckless. Every single one of them is exactly what a well-run retirement looks like. The cliff does not care. The natural pushback here is, can you appeal it? And the answer is yes, in specific circumstances. The SSA allows what they call a life-changing event appeal using Form SSA 44. If your income dropped because you retired, because a spouse died, because you divorced, or because you lost a pension, You can file SSA 44 and ask the SSA to use a more recent year's income instead. The approval rate for legitimate qualifying events is high, and the process is straightforward. But here is the boundary that matters. A Roth conversion is not a qualifying event. Selling a rental property is not a qualifying event. Taking a large capital gain is not a qualifying event. If the income spike was voluntary, a financial decision you made, the surcharge sticks for the full year. No appeal. No refund. You pay it. I want to address one more objection before we get to the protocol because I hear it from people who have been tracking this topic. They say, Caspian, the IRMAA Cliff only affects about 7 or 8% of Medicare beneficiaries. Most people are nowhere near those thresholds. And at first glance, that sounds reassuring. But if you were watching this video, run your own numbers. Because the audience most likely to trigger IRMAA is not the ultra-wealthy. It is the person who spent 30 years doing everything right. Maxing out a traditional 401k, building a substantial IRA balance, owning property. Now their retirement generates more income than they expected when they add it all up. The cliff does not target the careless. It targets the diligent. And the 2-year delay means you will not know you crossed it until the bill arrives. Here is the protocol. 3 steps you can execute before the end of this year. Step 1. Calculate your MAGI ceiling. Pull last year's tax return. Find line 11. That is your adjusted gross income. Add line 2A. That is your tax-exempt interest. That is your current MAGI baseline. Now subtract it from the IRMA threshold that applies to your filing status. For joint filers in 2026, that threshold is $218,000. The number you get is your conversion ceiling. The maximum additional income you can take this year before crossing the cliff. Write it down. That ceiling is the most important number in your retirement income plan right now. Step 2. Fill the bracket, do not spill it. Once you know your ceiling, you can do Roth conversions, take distributions, or realize capital gains up to exactly that line. This is what advisors call bracket filling. You are not avoiding income. You are loading as much income as possible into the current year without crossing the cliff. A conversion $23,000 below the threshold costs you nothing extra in Medicare. The $23,000 in first dollar costs you $22.97. The goal is to get as close to the edge as you can without going over. Run this calculation every year because your base income changes, your Social Security timing changes, and RMDs grow as your account grows. Step 3. Track the shadow on a 2-year calendar. Every income decision you make today has a Medicare consequence in year 2. When you are considering a large conversion, a property sale, or a lump sum distribution, do not just ask what it costs in taxes this year. Ask what it triggers in Medicare premiums 2 years from now. A simple spreadsheet with 2 columns, income year and Medicare premium year, is enough. Map your expected MAGI for the next 3 years. Identify the years when your base income is lowest. Typically the gap between retirement and when Social Security starts. Those are your highest value conversion years because you have the most room under the ceiling before the shadow reaches forward. Now step back for a moment and look at what this really means. The IRMAA cliff is not a punishment for success. It is a seam in the system between the income tax code and the Medicare premium structure. 2 agencies, the IRS and the Social Security Administration, are both looking at your MAGI, but on different schedules for different purposes with different consequences. Most retirement planning software optimizes for one of those systems. Very few optimize for both simultaneously. The 2-year shadow is what makes this genuinely difficult. You are not managing your current income. You are managing the echo of your income. 2 years from now, in a system that cannot be appealed after the fact. The people who navigate this well are not doing anything exotic. They are doing 3 things. They know the ceiling below the cliff. They fill the bracket deliberately each year. and they map the 2-year shadow before they pull any trigger on a large income event. That is the entire protocol. No special accounts, no complex structures, just knowing where the edge is before you step near it. If you are in your late 50s or early 60s and you have a substantial traditional IRA balance, the years between now and 65 are the most valuable conversion window you will ever have. Your income is lower. Your Medicare exposure is 0. IRMAA only applies once you are enrolled at 65. Every dollar you convert now cleanly below your current tax bracket ceiling is a dollar that will never show up in your MAGI during Medicare years. You are not just managing taxes. You are buying back control of your Medicare premium before the clock starts. If you are already on Medicare, the math shifts. You are no longer doing pre-retirement optimization. You are managing a live system that resets every year based on your prior year return. The ceiling still applies. The filling protocol still applies. The 2-year shadow is still running. You just need to track it with current numbers, not projected ones. The IRMAA Cliff is real. The 2-year shadow is real. And the protocol to work around both fits on one page. Know the ceiling. Fill the bracket. Map the shadow. I want to hear from you. What is the income source in your retirement plan that you think could push you closest to the cliff? A Roth conversion, an RMD, a property sale? Drop it in the comments. I read them all and the patterns are useful for everyone watching. If this breakdown was useful and you are managing your own retirement income in your 40s or 50s, hit subscribe. We put one of these out every week. Thanks for watching. I will see you in the next one.